Fowler with the Apartment Owners Association, and it's great to have you with us today. And our goal is to help you make and or keep more money than ever before. And we have an idea here with a 1031 exchange, into a 721 and how the 721 works. And so excited about getting that information to you today. Want to let you know that AOA does have a rent reporting that is done through our property management software. And we do also have a white glove, and we have started reporting to TransUnion, and that's something that you can do. It's $5 per renter per month, and that will help boost their credit. We're also in the process of getting it set up, not with just TransUnion, but with Experian as well. And with the property management software, they can do the online rental payments, and we do have an online rental application. And I just read this morning that 77% of Gen Z actually prefers to submit their rental application online. And so that's something that you can do through our property management software, along with them paying the rent online. So there's just more so much that we always have to do to adjust. And for this next generation, those are some things that are important to them. You may have missed some of our recent live streams. We did one on how to maximize your AOA membership. We talked about tenant buyout agreements with Dennis Block recently, so you could check our YouTube channel. If you're watching from AOAUSA.com, just check that channel, or search up AOA USA, and everything that we've done there will show up. And also, 12 o'clock today, we'll have another live stream. It will be how to win your eviction case. And hate to lose those, hate for those to be dismissed. And so we want to just give you the best information. And so much of it happens before you ever even get to court, and just being prepared and having all of your ducks lined up in a row. And so we want to be able to help you, give you the information that you need so that everything's in place, and so that you're not vulnerable to that kind of a thing. And then October 16th, that's next week, there's a live stream about balcony inspection deadlines. And then at noon, just again, another attorney, and continue to talk about different things different um, mistakes that can be made there. And then on the 23rd, the following week, we'll talk about rent control and whether that's a takings under the Fifth Amendment. We have so many people, so many members are always calling and asking, well, isn't this unconstitutional? And I would agree with you. It seems like we should be able to do what we need to do with our property. But anyway, so yes, so that would be great if to hear somebody talk about it. And someday, with what Clarence Thomas has said, it seems like someday we would get a favorable judgment, but who knows? We'll see, right? And also want to mention we have several in-person seminars that are coming up. October 21st, avoiding procedural mistakes in evictions in Sherman Oaks, and then also on the 22nd in Buena Park, we're talking about essential security deposit information. If you're not taking pictures, then you are probably not going to be able to take any of that security deposit. Uh, and so, yeah, there's a whole lot of other things there that are so important. So staying engaged, and go to that one at Buena Park. And then in Fremont on the 28th, and then in Santa Clara on the 29th. All these are in-person seminars, and it's avoiding procedural mistakes in eviction actions at both of those. And then also on the 28th, we have a second one. And what we're probably going to be able to do with that one is how to reject a applicant with a criminal background. And there is an individualized assessment that needs to be done. And we just want to, I believe that we're going to be able to pull it off where we can go through that. Um, and just kind of walk you through what that looks like. So anyway, those are some things that are coming up, a whole lot of stuff really that's coming up. And so anyway, hopefully you'll be able to make it to some of those. And anyway, want to thank K Properties for sponsoring this event. They're licensed in all 50 states, and they collectively they definitely have over. Matt, you'll have to tell me where you're at now, but definitely over 115 years of real estate experience. They've participated in over 50 billion, I'm sorry, 30 billion of DST 1031 investments, which is just incredible. And anyway, so our speaker today, we're joined, it's going to be Matt McFarland. He's Senior VP at K Properties, and he's in the LA area. He's helped clients complete over 2,000 transactions, totaling over 15 billion in real estate. He has deep expertise in 1031 exchange strategies and Delaware statutory trusts, and he's known for making complex investment strategies easy to understand, and that's why he is on the call with us today. So thanks, Matt, for taking the time out of your day here to be with us.
Absolutely, Jeff. Thank you for having me as always. I'm really looking forward to the discussion today.
Awesome.
Wonderful. Well, thank you again, Jeff and AOA, and to all of the attendees. Just want to first say thank you for taking the time out of your busy day and tuning in. We are really big on education. If you've ever spent any time with us, I'm sure you've seen us at the trade shows, and we've done a number of these webinar presentations over the years. But today we want to focus on kind of a concept that's been taking our industry by storm the last couple of years. The 721 exchange is another tax-deferred transaction that takes place in this two-step manner, which I'm going to get into in just a minute. But before I kind of go into that, just to touch on a few things, this information is purely for, educational purposes. When you're reviewing and looking at any investments, there's a full private placement memorandum that's available, which provides all the details. The DST properties and these 721 vehicles are only accredited are only available to accredited investors. These are very complex tax codes, Section 1031, 1033, and 721. And the DST structure, our goal, once again, is to make these as easy as possible to understand. That being said, we always encourage investors to consult with their tax and legal advisors in addition to consulting with us. These are, scenarios that we're going to walk through, hypothetical, not intended to indicate any specific, investment or an investor situation. Of course, past performance is not indicative of future returns. And all of this information, everything we do is within the securities, industry. So, we're governed by, the SEC and FINRA. So just wanted to start with a few of those bullet points to maybe just set the stage a little bit in talking about who we are at K Properties. For those that aren't familiar, we are a specialist firm, real estate investment firm based here in South Los Angeles. We have been specializing in the Delaware Statutory Trust properties for almost 20 years. Our founder started in the space back in 2007. I know Jeff mentioned a few figures. We actually have over 340 years worth of real estate experience. We've helped over 2,200 clients purchase almost 10,000 different DST investments. That totals over 39 billion worth of DST real estate. And really, our approach is to go really deep and specialize in one specific, concept and one specific structure. And what we've found is there are many investors, specifically in Southern California, but really all across the country, that have invested a considerable amount of their time, their effort, energy, and resources over the years into building wealth through investment real estate. And they have reached a point in their lives where they no longer want to actively manage. They want a lifestyle change, but they don't want to pay the immense taxes that would be due upon a sale, right? And they're asking the question, what are my options? And for someone that is in that situation, the DST structure could be a really good option for them. This functions as an alternative, a passive alternative within the context of a 1031 exchange. And we're going to kind of get into this in just a minute as part of the two-step, process that we're going to go through. But that's really what we focused on, over the last nearly 20 years is the Delaware Statutory Trust Structure, which is a 1031 exchange vehicle that allows investors to passively participate in higher quality institutional caliber real estate deals structured in this specific way. So just before we kind of jump in any further, the 1031 exchange has been around since 1921. It's been a part of the tax code for over 100 years. Section 721 has also been a part of the tax code for decades. Not quite as long as the 1031 exchange, but it has been around for many decades. The reason why most high net worth individual investors have never heard of it is because this has historically been more of a Wall Street transaction, right? A 721 allows no gain or loss to be recognized when a property is contributed to a partnership in exchange for interest in the partnership, right? So a few things have to take place, right? The property has to be contributed in a specific way to a partnership. Most of the time, the partnership structure is a real estate investment trust or a REIT. So that in and of itself um, kind of places this type of tax deferred exchange on more of an institutional kind of playing field, right? You're typically dealing with property types that a real estate investment trust or a large partnership would be looking to acquire, which is typically not the type of real estate that a kind of a mom and pop high net worth individual investor would own, right? Hence this kind of two-step process, right? Which we're going to get into. So it all starts with the sale of the relinquished property, right? This is the investment property that the investor has owned for many years, that has accumulated a significant amount of capital gain. First and foremost, the investor is going to execute a 1031 exchange. The 1031 exchange allows them to defer all of the taxes that would be due upon an ordinary sale. So think, your capital gains tax, your depreciation recapture tax, the Obamacare, Medicare, surtax, any and all taxes are first deferred through a 1031 exchange. And in the purpose of this discussion and the 721 exchange specifically, the 1031 exchange must be made into a Delaware statutory trust, right? So once again, the Delaware statutory trust, think larger kind of institutional caliber real estate deal where investors can buy a fractional interest or an undivided interest in the property and maintain a very passive ownership role, right? So the DSTs are created, to provide, preservation of principal, predictable income, and hopefully some modest, appreciation over the holding period. These are typically newer Class A, fully stabilized properties, majority outside of California. In more of the growth states, can be anything from multifamily, industrial, medical, retail, self-storage. All the main food groups are represented in this Delaware statutory trust structure. So step one, sell the relinquished property and 1031 exchange into a DST. The investor would own an interest in the DST. That DST would be held for a certain period of time. Usually that could be, 2 or 3 years. It could be all the way up to 10 years. It depends on how the DST is structured. And then step two would be that DST, that property that the DST owns would be contributed to a partnership. And so the investors who own interest in the DST would effectively be trading their beneficial ownership interest in the DST for operating partnership units of this greater partnership or REIT. And they can do that through a subsequent tax-deferred transaction, which is called the 721 exchange. So big difference here. The 1031 exchange is a cash transaction, right? Investment property is sold, money, proceeds flow to a qualified intermediary. From the intermediary, they flow into the DST, right? The 721 exchange is a non-cash transaction, right? Beneficial interest in the DST is traded for units, which typically mirror shares of a partnership or a REIT, right? So that's the big difference. And we'll get into this in just a moment, but the reason why this has become so much more popular in the DST space is it provides investors access to additional diversification and potential liquidity, all within the context of this tax-deferred transaction. So this is just another kind of representation of what I just described, but just to kind of go through it again and be maybe a little bit repetitive. So hopefully this kind of sinks in. So the Delaware so the DST owner, right, on the far left of the screen in the orange box, they own an interest in the DST property. Right, the DST property is contributed to the operating partnership, which is owned and managed by what we call the 721 vehicle. This can be a real estate investment trust, could be any other type of partnership. The operating partnership in the 721 vehicle owns a diversified portfolio of properties, right? A lot of these REITs, they could own several $billion worth of properties. So moving from the DST property, usually that's a single asset. The investor, through contributing their interest to the partnership, is achieving substantially more diversification. And in terms of what they own, they actually own these operating partnership units, right? Which is shown here at the bottom of the screen within this greater operating partnership. So these are more the mechanics. I think it's important to kind of understand the mechanics of it. We'll get into a little bit more of some of the potential advantages and disadvantages, and maybe drill down more into why this has become an increasingly popular kind of exit plan for a lot of these DST companies. So starting kind of getting into that topic, asking the why question, right? Why do investors utilize, the 721 exchange? What is attractive about this? The first has to do with the tax advantages, right? So I mentioned this a little bit earlier, but typically when, real estate is sold, the investor pays taxes on any capital gains realized as well as depreciation recapture. This ultimately leaves the investor with less capital to work with after the real estate is sold, right? The 721 exchange allows the investor to avoid this potentially hefty tax liability through a subsequent tax-deferred exchange. So think of the 721 is very similar to the 1031 exchange from the standpoint of it allows the investor complete tax deferral privileges, right? And here, in the context of the 721 exchange, the capital gains are deferred until the investor sells those operating partnership units, or the contributed property is sold by the acquiring operating partnership, right? So there's two ways that liquidity can be triggered in the context of a 721 exchange kind of vehicle. The first is the investor liquidating, choosing to liquidate their own units and trade them for shares and sell the shares for cash. That would trigger the tax liability. Or if the property that is within the operating partnership is sold as a whole, that could also trigger a tax liability for the investors. So how a lot of these funds are positioned is the operator of these investments, these partnerships, their intention is to allow the investors to control their tax destiny, so to speak, right? They want the investor to decide when they want to realize that capital gain, or better yet, their estate to be able to come in after, they receive the full stepped up basis to be able to come in and sell with limited to no, tax liability. That's really kind of the main draw or main thought of the 721 exchange, and we'll drill down into a little bit more of that later. The other advantage, and I mentioned this a little bit earlier, is a diversification, right? So diversification can be achieved through investing into a DST property or multiple DST properties, which a lot of investors do. When they're selling a single investment property and doing a 1031 exchange, we always encourage them to diversify into several DSTs to limit concentration risk. That diversification can be stretched much more significantly further in the context of a 721 exchange, right? These 721 vehicles allow the investor to access even greater diversification than they have in their portfolio, which may further reduce concentration risk, right? So we give an example here at the bottom. So instead of an investor owning a $500,000 DST interest into one FedEx leased industrial building, the investor through a 721 is hypothetically able to exchange into a diversified portfolio containing over 2 million square feet of industrial, multifamily, retail, medical, mixed-use properties with many, investment grade users, right? FedEx, Amazon, these are just examples. PepsiCo, Walgreens, CVS, Fresenius. I think you guys kind of get the picture. This is ultimately a major draw, that investors have to potentially limit risk through diversification. Another draw to the 721 exchange is income potential, right? And the income potential certainly exists in the context of a DST as well. But just like how most DSTs are set up to provide that conservative, kind of consistent, durable income, these 721 vehicles are set up very similarly, right? So investors will potentially receive the income generated through the distributions or the rental activity of the properties that particular vehicle owns. And the goal is always to increase the income potential over time through a combination of accretive acquisitions and portfolio optimization. So that kind of brings up another point. So the 721 vehicles are a little bit more dynamic than the DST investments. So when investors participate in a DST, it's usually a single property with a specific business plan And during the course of ownership, that DST is not going to change the composition of what it owns, right? You invest into a Class A 300 unit multifamily property in Dallas, Texas. That's what the DST is going to own the entirety of its life cycle, right? Its business plan. In a 721 vehicle, you're dealing with a much more dynamic vehicle, right? These vehicles can, as new money is kind of brought in, they're able to acquire, other properties to grow the portfolio. They could exchange properties within the portfolio. So it is a little, it is much more dynamic and a much more flexible operating vehicle than a DST, which has its advantages and disadvantages, right? The advantages, clearly, if you're able to accretively acquire properties, that could enhance your valuation and overall distribution. Obviously, with the more operating latitude, there's a higher likelihood that the composition can change, for better or for worse. So these are all things, we're speaking very high level, but these are all kind of discussion points that we really drill down into when we're having conversations with individual investors that are considering individual DSTs that have individual business plans that are connected to the 721 exchange. And then the last thing here, just like in a DST or any other real estate investments, investors will enjoy income potential that is tax advantaged via depreciation and other write-offs to help shelter the distributions. Another component, just like most real estate investments, there is appreciation potential. So investors are able to participate in potential appreciation, realized at the individual asset as well as the enterprise value level. So this is where this is where obviously it's a little different than a DST. In a DST, you own a single asset. That single asset has a specific value when you originally invest or participate, and your future value is dependent on what that single asset is worth when the property is sold, right? In the case of a 721 exchange, you own operating partnership units within this much larger, more diversified pool of properties. So your value is not just connected to the original property that you own, it's ultimately connected to the entire enterprise, right? The entire value of the entire pool of properties through the entire enterprise, which once again could be, advantageous, it could be disadvantageous depending on obviously the composition of what that underlying vehicle owns. And this, once again, can take place through newer acquisitions. There's, there are different decisions that could be made in the context of a larger kind of dynamic portfolio of assets that's made on an individual property level, all of which can contribute to appreciation potential within the 721 exchange. So the last or one of the I would say one of the most significant or most potentially attractive draws to the 721 exchange is the liquidity potential, right? And specifically because the 721 vehicles are positioned to be more liquid than your traditional DST, right? So a DST is a buy and hold, cash flow sell strategy. So you buy into an existing property that has usually a stabilized rent roll. That property has a business plan of typically being held for anywhere from 3, 4 to 10 years, depending on, the strategy. And investors, really need to be comfortable with having their money illiquid or tied up during the operating period of that DST. If investors wanted to get out earlier for whatever reason, it's possible, but it's very difficult. It would involve a secondary market sale, which could potentially impact the value of what they're able to liquidate, right? So the DSTs generally are a more illiquid vehicle. Many of these 721 exchange vehicles offer a much more enhanced liquidity potential, right? So this is especially attractive to investors who are looking to have maybe a little bit more potential control on when either they realize that liquidity, or if or when their estate is able to realize, the liquidity. So most 1031 exchange investors, I'm sure you all are very well aware, they have no intention of ever realizing the gain throughout their lifetime, right? Their full intention is to continue to swap till they drop, right? The whole plan, the whole purpose of this is I'm going to pass this to the next generation as tax efficiently as possible. And that is achieved through this concept of a stepped up basis, right? Once an investor passes away, their heirs, their estate comes in and they're able to step up the basis to current market value. And the thought is, they step up to current market value, at which point the property is sold at current market value, and there's zero tax liability associated with that from a capital gain or depreciation recapture perspective, right? So this is one of the ways that wealth is transferred generationally in our country, right? Specifically in the context of real estate. So a typical DST investor may be attracted to the 721 exchange because it may provide their estate the ability to realize that stepped up basis and then more immediately liquidate upon having that basis stepped up, right? And allow the estate to make a more immediate disbursement to all of the heirs pursuant to that investor's will and trust. So that's a main draw, right? That's a significant draw. Now, there's a lot of nuance to that, which we don't have the time to go into all the details on this conversation. But that is certainly a driving force, towards the 721 exchange. The other example I'll mention is this could be this could be attractive for an investor who is maybe looking to realize some of that gain during the course of their lifetime, but they want to do it in a little bit more controlled manner or fashion. So, for example, say an investor does the 1031 into the DST, then they 721 into the REIT or partnership. And let's just say the investor wants to spread their tax liability across multiple years. So what they could do, assuming the liquidity is there for them, they sell $50,000 worth of their shares or their operating partnership units 1 year. And they can prepare for that, right? Elsewhere in their portfolio. The next year, maybe they sell 25,000, and the next year after that, 75,000, right? So it gives investors the ability to be a little bit more involved in terms of the liquidation strategy down the line. I already mentioned this with respect to estate planning. The one other thing I'll mention is those operating partnership units, much like DST interest, can very easily be split equally across all the beneficiaries of the trust. Also similar to the DST interest and any other real estate ownership interest. The beneficiaries receive the stepped up basis to avoid capital gains and recapture. And really, like I said, the main draw for a lot of people is planning for the future with the opportunity to transfer wealth, most efficiently. So what we're going do here as we're kind of nearing the end of the webinar is go through a hypothetical case study. So an investor owns an interest in a single tenant net lease FedEx distribution facility, which we saw from a few slides ago. So by completing the 721 into the 721 vehicle, the investor is able to potentially benefit from the following, right? Full tax deferral, first and foremost, via the 721, diversification. Instead of owning interest in just one property, they now own interest in over 2 million square feet of 88, properties, right? Just as an example. Diversification across 33 states. We talked about, upside potential. The investor has the ability to participate in the entire portfolio's appreciation potential and enterprise value, income stream protection and enhancement through that diversification, is also a potential advantage. Increased income potential, right, as the vehicle has the goal of increasing the income over the hold period through accretive acquisitions, distribution, dispositions, and portfolio optimization. So does the income potential, increase as well. We talked about, the tax benefits from an operating perspective, the advantages of depreciation and other write-offs. Liquidity, right? The investor has a potential liquidity to sell when they want to sell and have a little bit more control over that than a traditional piece of real estate or DST. And then another main advantage is estate planning benefits, right? Allowing the investor to, upon their passing, that interest to be easily divisible, the step up to be realized, and the estate to ideally immediately be able to sell and get access to the cash. So in closing here, I just want to point everyone to our website. If you haven't ever been on our website, I encourage you. It's kpi1031.com. Here you can get free access to our marketplace of all the different 721 exchange UPREIT opportunities. We have an array of different debt-free and leveraged DST investments, and typically 20 to 40, even more than that, different offerings. In terms of education, we'd love to send you a free book on the 1031 DST property, which was published by our founder. We have a free subscription to our 1031 Digest magazine. We have a plethora of free educational information on the 1031 and 721 through conference calls. We have weekly exchange webinars. We also our founder just published very recently, actually a whole book on the 721 exchange. So if you're interested in receiving one of those, please do reach out to us. And then we do various, educational events also, in the LA area and across the country. So with that, I thank everyone for your time. Hopefully you learned something new today. And I know this is a fairly complex, strategy, but hopefully I was able to deliver it in a manner that was a little bit more bite-sized and digestible. So I want to thank everyone for your time. And if there's any questions, happy to take those as well.
Great. Thank you, Matt, so much. If you are watching on AOAUSA.com, there's that blue help bubble. You can enter your question in there and then they'll funnel that over to me. Of course, if you're on YouTube, just put it in the chat and then we can get to your questions. So we'll give you a minute to get to that. And Matt, what's the next in-person event that you have that you're going to be going to?
It's funny you asked. We have one this evening
Oh,
down
really?
in Costa Mesa. Yeah.
Okay.
So
Is that open for people? Is that too late for people to sign up for at this
I
point?
think it's too late at this point. Yeah,
Yeah.
we've hit our capacity, but we're hosting another event in early November in Pasadena, in the Pasadena area. So if anyone's
Okay.
interested in attending, yeah, definitely reach out to us. You can just go to our website and call our main number, which is shown here.
Right. And again, where do you guys have offices? Because I know you have multiple locations there.
Yeah, so we're headquartered in Torrance in the
Okay.
south part of LA County, South Bay. We have some satellite offices kind of sprinkled across the country, Las Vegas, Charlotte, Boston, New York. But most of our operation is housed here in the South Bay.
Great. Great. All right. Well, we'll get to questions here. Um, on YouTube, have DST uprates become a significant source of new capital for REITs?
Yeah, it's a good question. Significant is a little bit of an arbitrary term. I think you've seen a lot of the major REITs move into the DST space over the last several years. And from the REITs perspective, they clearly are kind of able to diversify their capital raise a little bit, right, through this two-step process, through creating a DST first that will ultimately be brought into their REIT. A lot of these REITs are so large that I don't know how significant it is at this point, but I think the goal is to kind of diversify the REIT's capital raise through offering like the DST, where investors can enter the REIT through this two-step transaction versus just, contributing new money or cash, directly into the REIT. So, um, yeah, hopefully that answers the question. But yes, we have seen a large entrance into the space by these big REITs.
And so the 721 that they enter is determined on the front end, right? It's not like they get it to pick that after the sale of their property, or when do they get it? You have more than one 721, I believe, that you're offering.
Yeah, I'm really glad you asked that, Jeff, because I should have mentioned that in the presentation. So there's two different approaches that companies take towards a 721 exchange. There are those where they create the DST, and that DST is required to be contributed to the REIT or the 721 vehicle. We would call that a mandatory 721 exchange. The other approach is an optional 721 exchange.
Mm.
So in that scenario, when that DST property is acquired by the REIT, the investors would have the option to participate or not participate. And if they didn't participate, they would be cashed out, their portion of the sales price, of the property, and those funds can be applied to another 1031 exchange, or they can just be taken directly in cash. Everyone's situation is a little bit different. I would say, all things being equal, which they never are, if you have a mandatory, 721 and an optional 721, the optional 721 is going to be the way to go, right? Because it allows the investor at that future point in time to vet the REIT and what it offers relative to other investments that they may have access to them, whether it be in the DST space or maybe just another direct acquisition, or maybe in a post-tax state, right? Maybe there's an investment that is worth them, paying the tax and investing, directly into in cash. So, we're generally of that mindset. If all things being equal, we definitely prefer, the optional approach, but there's each company kind of positions a little bit differently. All that to say, when investors are considering different DSTs, the ones that are a mandatory 721 exchange, that is made abundantly, clear to them going in.
And so this is an upread. This is and like they're able to see what the portfolio holds, right? Like
Mhm.
percentage of multifamily housing versus triple net commercial property versus whatever else might be in there.
Yeah, absolutely. And a lot of these REITs too have, an established track record. A lot of them are, even publicly registered with the SEC. They have, full website that you could very easily access a lot of that information.
Hmm.
I think the challenge becomes when it is a mandatory 721. You can do all the due diligence, kind of leading up to your 1031 into the DST. But once you commit to the DST, you're along for the ride, so to speak, right? So if anything were to change over those 2, 3, 4 years, however long the DST phase exists for, um, the investor wouldn't have the opportunity to kind of opt out at that point. And so it's just, a little bit of an extra risk because you're doing, due diligence, potentially years in advance of your ultimate entrance, into that REIT.
Hmm. Okay, Karen on YouTube. Our DSTs have debt with each holding. We have not yet come to the end of a holding and do not know how the debt works. And her question is, what happens to the debt with a 721?
Yeah, good question. So typically the debt is assumed, into the 721 vehicle. Once, you're in the 721 or in the REIT or partnership, whatever structure is used, at that point, the REIT can, refinance or they can do, what they need to do. It's a more flexible, structure from that perspective with respect to the debt relative to a DST where it is more difficult to refinance. So in most cases, that debt is initially assumed, by the REIT or the 721 vehicle, and then, it would be dealt with after that.
All right, Henry, is it difficult to liquidate my shares in DST in order to exchange in 721? And how do I determine my current value of my shares in DST if I want to liquidate?
Yeah, it's a good question. It is fairly difficult to liquidate. It would involve a secondary market transaction. So effectively, Henry, you would have to find another investor that's willing to pay you the amount that you're willing to accept, for your interest. So, to kind of answer your question, with respect to the value within the DST at any point, if you were seriously looking to liquidate, the best way to ascertain, what that value is to figure out what someone's willing to buy you out at. And in most cases, because the secondary market is not extremely robust in the DST arena, there would be a certain level of discount, that would be applied. Not always, but a lot of the time. So our recommendation for any investor that's in a DST is, before investing, just be comfortable with the fact that your money's, going to be tied up for the full duration of that DST and its business plan. Obviously, if an emergency happens or you really need the money out, you can do it. You can sell, but unfortunately, your valuation coming out in a secondary market transaction is likely to be inferior to the valuation that you would get out if you just stayed the natural course of the DST.
All right, is there public information available for past performance of 721 upreads? And you mentioned that there is, but do mm,
Yeah, it depends. It depends on the REIT, right? So there's different structures that different companies use. Some companies have, publicly traded REITs on the New York Stock Exchange, right? And it's very easy to access the information there. A lot of these companies, they're publicly registered but not publicly traded, right? So they're not, they don't have second by second liquidity, but they do go through the whole public registration process. A lot of times those the information is publicly accessible. There are other REITs or funds that are private. They're not publicly listed, so that information would be available, but in a less public format. So that's typically within like a private placement memorandum or a prospectus. All of that, regardless of how it's structured, is accessible, for the investor to
Mhm.
to review and kind of do their due diligence on, prior to, considering any particular strategy. So it depends, but that's typically, what you see.
And you probably have a list of UPREITs that you've participated in. Is that something that's available for people to take a look at and see? And obviously, whatever's happened in the past is not, you can't promise that it's going to get that same return or anything, but do you have something like that?
Yeah, there is information, yeah, that we could share on that in terms of like our experience, because we have seen different utilizations of the 721 and different iterations of it. So absolutely, if anyone's interested, definitely reach out to us and we'd be happy to get you set up with that info.
Right. And what is your email? I see Shay's email on there.
Yeah, it's replace Shay and put in Matthew, Matthew.
Okay, yeah.
Same
There we go.
domain.
So yeah, so you can email Shay or Matthew there. Just change the name if you want that one. And okay, great. We've got a couple more here. We'll try to finish this out. Can you 1031 straight into 721 bypass the DST, or do you have to 1031 into a DST and then transition to a 721?
Yeah, so if the DST is involved, the 1031 exchange would also be involved, right? Because the DST is step one of this two-step transaction.
Mhm.
The only way that an investor would be able to avoid the DST and the 1031 exchange entirely is if they happen to own a property of a high enough caliber that is being purchased directly by a REIT or some type of partnership. And not just that, but that specific partnership or REIT would have to specifically offer the investor the ability to 721 exchange and convert their ownership in their property for the operating partnership units. I have seen this a couple times in investors that I've worked with. But typically, like our typical DST investor is not going to be in that position because most REITs are looking at a much higher like valuation in terms of the properties that they're acquiring. So it's a little bit more rare for a typical DST investor. Now we've worked with obviously a huge array to specifically have a property that is specifically purchased by a REIT that specifically is affording them the ability to trade, to trade into the partnership.
Great. Okay. And here we go. Do you have associated real estate agents so the entire transaction from property to DST would be streamlined?
Yeah, so we would encourage any investor, to reach out to the AOA. I know they have a kind of an in-house brokerage team, and I'm sure they could put you in touch with people. We're not involved on the initial sales side of the down leg transaction. So the investment property that you currently own that you're selling, K Properties would not be involved in that. But there's many great brokers or real estate advisors that would be able to help. And I would point you back in the direction of the AOA for that or any trusted local agent for that matter.
Great. And as far as the return goes, what's been the average return? And obviously this is not, it's not gonna, you're not telling us what it's going to do, but just past wise. Just what numbers are we looking at here?
Yeah, I mean, typically, yeah, you're absolutely right. I mean, there's been a huge variety, but I think generally speaking, for a DST in particular, like I mentioned, the priorities are, preservation of principal and conservative durable income, over the holding period, with hopefully some modest, equity appreciation. So from a starting, cash flow standpoint. Um, Most of the investments that are out in today's marketplace are anywhere from low four to mid six, as a cash flow, as a starting cash flow. And the expectation is for most of these, that cash flow would increase over the holding period as rents are raised and expenses are managed. Obviously, there's different degrees of risk. Over the holding period and how to accomplish that. But that's typically what an investor is kind of looking at within the DST space. And then in terms of the REITs, like the 721 vehicles, I mean, most of them are going to be in a similar range, of the income that the DSTs are producing. So, for investors who are looking to potentially go that direction. In a lot of cases, they're not taking like a substantial, step forward or a substantial step backwards in terms of their expected income. They're able to maintain, that predictable, hopefully predictable, mailbox money. Of course, things happen, like cash flows can be lower than anticipated, so on and so forth. But that's typically the range that the DSTs and the REITs kind of target.
Great. And last question we'll take here, Greg. What is the typical cost commission in the 1031 to a DST? And what is the typical cost commission in the 721 UPREIT?
Yeah, so every DST is a little bit different. So most of the cost in the DST is built into it's built in upfront, on the specific offering. So the investor is not, they're not paying anything out of pocket. All the fees are there, but they're built in, to the DST offering. The same is true of the REIT. Typically, there's a little bit less cost in the transition from the DST to the REIT in terms of like that specific transaction taking place. But there could be more with respect to, ongoing cost and performance-based fees. So they're all kind of within a similar range, expressed differently. Greg, if you have, if you specifically, we can take you through like a prospectus or anything and detail out all of this. And anyone else who's interested, definitely reach out to us. We'd be happy to go through that in more detail.
Awesome. Hey, Matt, thank you so much for taking some time to answer the questions and just give us a presentation like this. Really appreciate it.
Absolutely, Jeff. Thanks for having me.
All right, everybody. Thank you for being members with us and just keep in touch here. There's a whole lot going on in the LA area. So hopefully you've gotten, and also on a state level, we've sent out several different political action campaigns to try to um, keep things sane here as much as possible or limit the craziness. So hopefully you've been engaging with those emails. And if you haven't, sign up go to aoausa.com, look for the PAC, and you'll see some campaigns there that we're running and that we want you to participate in, and hopefully we can make a difference here. But really, we're a grassroots organization. We want to empower you and give you a voice and just let you know, hey, this is something to chime in on, and it directly is going to impact what your property's worth and how you're able to make a living off of it. So we want to encourage you to do that. And again, we appreciate you so much, and it's really an honor. I mean, you guys are such an incredible group of people that have made wise investments and been incredibly successful. So it's an honor to be with you. And we'll see you at 12 o'clock for those of you that want to learn more about some of the pitfalls in trying to evict somebody. And anyway, thanks again. We'll talk to you later. Bye bye.